We've got Kilol Pandya, who's head of fixed income at Daiwa Mutual Fund, who's right here with us in the studio. Kilol, to begin with, we've got the credit policy coming up next Tuesday. Do you expect, like people are increasingly beginning to expect, that the repo rate once again will be left untouched and you will see more of a focus on the CRR being cut?
Yes, I am of that opinion. Cutting CRR rates or basically assuaging the liquidity situation has a far more urgent nuance to it. We continue to reel under extreme liquidity tightness. We are over 1 trillion today itself. Notwithstanding RBI's hint that liquidity will improve in the first fortnight of April, we require cash injections sooner rather than later. Whether that comes by way of a CRR cut or OMO actions, or as I always mention, the wild card being government spend. We need to, by whichever way it comes, cash is welcome at this point in time. So from that perspective, the need for assuaging the liquidity front is far more urgent than cutting repo rates, which is kind of an indicator of where we are on the interest cycle, and it has medium to long-term implications as compared to CRR cuts, which has an immediate implication.
So, Kilol, cash injection is what you have maintained as one of the points, because there is quite a bit of supply pressure that the bond market is reeling under. But say that there isn't a change in any of the policy rates, that there will be the regular infusion of liquidity via OMO operations. Where do you see bond yields stabilizing then?
Bond yields, if this comes to pass, that there is no injection by way of OMOs or CRR, and we continue with the current state of borrowings, then the yields might start worsening from here, because clearly at 65,000 crores a month, the gross borrowing is more than what the system can handle as things stand now. So we require slackening in terms of the tightness which is being maintained currently. Otherwise, I'm afraid the gilt yields will continue drifting upwards. It will not be a sudden crash or sudden movement upwards, but they'll continue drifting upwards, which is detrimental to all the stakeholders. So I strongly believe that we require some slackening in the tightness on the liquidity front.
Sure. So, Kilol, to the extent that people are beginning to not expect anything on the repo rate front, and assuming we do see a repo rate, a cash reserve ratio cut, would you still say that the situation in the fixed income markets is going to be far worse than it was at least maybe 2-3 months back, for the simple reason that you're continuing to see rates at the short end of the curve climb?
If the liquidity scene improves, then the short-term rates will be the first to be impacted on the positive side.
But how much do you see it coming off by? Should we see, let's say, a 0.5% cut?
If a 0.5% cut is brought about, then we should see the liquidity. You see, the liquidity is at $1 trillion negative. Okay, if we are seeing something like, say, 40,000-50,000 crores come in, we will be pretty close to, or will be within RBI's own comfort zone of 1% NTDL. Then the yields should come off pretty sharply. As it is, if you are taking a look at the money market yields on the short term, or even treasury bills in the shorter end of the curve, the movement they have seen from March till now on the non-SLR side has been in excess of a percentage point downwards. And that is on the back of a liquidity situation which was close to 2 trillion moving down to 1 trillion. So if we are seeing a further reduction of the liquidity tightness by half, then we should see the moves. Of course, it will not be a 1:1 move, but the short-term rates, say the 3-month rates, can come off significantly from the current levels, maybe by another percentage point.
Sure. So, but do you believe that worsening global macro factors coupled with oil prices likely once again climbing, do you believe all those factors have the potential of sort of derailing all this maths with the rupee weakening, and then you're likely seeing RBI intervention and all that?
These are concerns. Definitely they exercise the debt market participants as well. The global prices, inflation, fiscal slippage, the borrowing program, these are all concerns that continue to dominate and worry the fixed income participants. However, given RBI's own track record in the recent times, I'm confident that ultimately the math, the chances of it getting derailed completely are slight. However, some of the actions which had been planned, say a quarter ago, may have to be postponed or diluted or both. Those seem to be the probable ramifications of the current macroeconomic situations, which are far adverse than they were, say, a quarter back. But I doubt if the fact that we are at the peak of interest cycle and that from here onwards we can only soften. I really doubt if I doubt if the game has changed.
And how concerned would you be with respect to the worries that most people have about overshooting in terms of fiscal deficit targets?
Yeah, that is a worry which I just mentioned. In fact, fiscal slippage continues to exercise us. The budget, once again, may have been based on certain assumptions which might ultimately prove to be too optimistic, in which case fiscal slippage is something which we have to watch out for.